Welcome to the FinLink FinCast, where we talk with the experts about everything wealth management and CPA, especially as it pertains to M&A. I'm your host, Andrew Heinen, and today we have a really special guest, a true thought leader in the CPA lending space, Shannon. Hey, welcome, Shannon.
Thanks, Sander. Thanks for having me.
Of course. A little bio. Shannon is a senior vice president of commercial lending at United Midwest Savings Bank, and he's a seasoned expert in commercial lending and accounting firm acquisitions with over 30 years of experience. As a senior vice president at United Midwest Savings, he specializes in providing tailored financing solutions for accounting professionals nationwide. Having facilitated over 400 accounting firm acquisitions, Shannon is a trusted advisor known for his deep expertise in deal structures, valuations, and transaction processes. His client-centric approach ensures CPAs, EAs, investors, and consultants receive strategic, personalized guidance throughout every stage of the acquisition process. Prior to United Midwest, Shannon held leadership roles at Live Oak Bank and United Community Bank, refining his expertise in SBA lending and business development. He is passionate about empowering accounting professionals to achieve their growth objectives and is an active contributor to industry discussion and events. And yeah, we did work together in the past at Live Oak, so I have seen you at work in discussion at those industry events. So
Yeah, you've
um,
got to hear my loud, deep voice carry across the sales floor on deep conversation on deal structures. So
of
yeah,
course, riveting combos.
yeah,
Uh, well, I'd love to just pick your brain a little bit today. Really, it's interesting. We're typically hearing a lot of lenders in investment advisory on the FinLink side, and it's nice to have a CPA lending expert. So, would love to
thanks.
get kind of an overview of what's going on with United Midwest, maybe a little history of the bank, and there we can go from there. We can look at some trends in the M&A space for accounting firms.
Sure, sure. Yeah, so I joined United Midwest 18 months ago. We've completed about 75 million, probably about 80 transactions since joining the team. They wanted an accounting focused team. They recognize you know the security and safety of working with CPAs and typically low default rate. Obviously, if you manage your own books, you can't be managing other people's. So hopefully they're good at paying their bills. And yeah, we've just been it's been a really fun year and a half. Really moving over more just to become more agile and say yes more often. There's a lot of great entrepreneurial opportunity, whether it's a non-CPA buying an accounting firm, right, such as an MBA type or a tech-driven individual or an HR, human resources-driven type person. A lot of this is operational management, and so that is starting to be recognized in the industry. There's not really a true one-to-one CPA succession model that exists out there. The AI CPA is, they've fallen short in recruiting new members, right? And so there's a lot more CPAs retiring than there are gaining new licenses, and so there has to be a new solution for consolidation and technological management. Offshoring is really big in the industry now, and then of course, the all-ever topic of private equity is constantly moving the needle in the conversation of.
Yeah, I'm sure you do have conversations with financial advisors looking to buy CPA books and CPAs looking to buy advisory books. Is there kind of I guess I know there is an uptick in that. Have you been having that discussion a lot
Yeah,
lately?
it's more of the first than the latter. Most CPAs will organically grow their investment advisory on their own, right? If they decide to do so and make the decision, or someone shows them or teaches them how. But what the investment advisor's recognition is it's a fertile ground for, finding those new customers, growing their book of business through just the organic conversation of tax mitigation, tax strategy. Investment advisory organically falls into that conversation, and I think that the curious we're it's just becoming an Amazon community, right? Where consumers are expecting an all-in-one type service now from their financial advisors. They're not just wanting where to invest. They're wanting to know how to tax mitigate, how to estate plan, what insurance needs they might have. So this array, maybe there's legal advice tied into that. Obviously, on the other side of that equation. So you've got this conglomeration of different professional services, I think, all coming together in this Amazonian type community where the consumer has this expectation of, I don't want to talk to five people about five different things. I want to talk to one person about five different things, and be able to handle it all in one stop shop. And so I think the consumer is demanding it a little bit, right? But the intelligence of the industries, meaning that investment advisors recognizing that capacity to be able to see a high net worth individual and then attack's probably not the right word, but business development towards that individual, right? Cater towards that maybe individual's needs and use that the trust that exists in the financial reporting to be the trust that carries over into the advisor side of the business. And so,
Right.
so it's hot. And the multiples still work really well too, right? So the accounting space is still very attractive in comparison to if I go out and buy an investment advisory book of business, 2x, right? I mean, that's the minimum, right?
Three. Yeah.
Yeah. So I don't
Yes,
know,
revenue. Yeah.
but yeah, you're still looking at average multiple of 1.2 times gross, on CPA firms.
And
So
has that stayed pretty consistent over
it's
the years?
the market's pushing up. Yeah, the market's definitely pushing up. Private equity is causing noise on the top part of the market, and that's bleeding down to the lower part of the market. I'd say what's changed more, maybe not as much multiple as structure. So there's a greater expectation for cash at closing than there ever has been in the Sullivan accounting firm, because of the private equity pressure creating that. And then as well, I think we've created a little bit of that pressure too by having a capital offering in the market and saying that there is equity value in these businesses and we are willing to lend money against it. I think that's causing to an expectation, but there's still a lot of structure play in these deals, meaning that sellers are still willing to participate. They still understand that they should have skin in the game and that they have transition and retention responsibility in the deal just as much as the buyer does, right? Not just as much, but have some, right? Some accountability in that transition.
So yeah, speak a little bit about that, that retention clause. Like how do you use those in the deals that you structure?
Yeah. How many ways can you slice a piece of a pie, right? So, do you want the big piece or are you on a diet? It varies very much from deal to deal. I always say beauty is in the eye of the beholder. But there's a large variance of how that's worked. Easy way to explain it would be, say you've had 80% cash at closing and then 20% seller note. That 20% seller note then would be tied to a retention period and could reduce or would reduce based on attrition, right? Or loss of clients. If there is a loss, the note reduces. There's no upside under SBA lending because SBA doesn't allow for an upside, but you might, in a regular cash deal, you might have an upside if you wanted to, an earnout component per se, but again, not a viable SBA component, for my type of financing. We only allow for downward adjustments under our financing. But so we also do a creative thing where we'll create an escrow, right? So we might fund the full purchase price or the full valuation of the firm, but then take a significant portion, 15, 20, 30%, set it aside for a year. It just sits in an escrow. You're still making payments and interest on that. That is the cost to you as a borrower and a buyer. But the benefit is the seller knows that money's waiting for them at the end of the rainbow as long as they hit the number. If it doesn't hit, the number doesn't hit, the money comes back to the bank, pays down the loan re-amortizes. And that just still allows for that convenient 10-year capital, 10-year amortization rather than a short-term seller compressed note that's like once a
Yeah.
repayment done a year or two, right? So that's the benefit of an escrow. But again, I've seen now too, what's really cool with the SBA and the way we're doing financing is sellers can retain equity. So, a seller just keeps 10 or 15%, keeps skin in the game, and then has a vested interest in the future success of the firm.
And that
Uh,
previously wasn't allowed, right?
Correct. Under the SBA program, it had to be 100% transfer of ownership.
Right.
And the seller was required, if anybody that was in receipt of proceeds was required to not be in a key man role greater than 12 months from the date of acquisition. Now, as long as they retain ownership, 5, 10, 15, if it's under 20%, they don't have to personally guarantee. If it's over 20%, they have to personally guarantee. But if they retain that ownership, they no longer have to follow those key man rules. So
Right. How I I, I mean, having kind of been in your seat with succession plans, I, I guess a good message to get out to the sellers that we've heard over and over again is get your succession plan in place early. There's never enough time to get this all vetted out. Let your team know, know the buyer, kind of have that transition period. What are some of your tips for getting a succession plan or an acquisition plan in place for especially for a CPA team?
yeah. Well, the good consultants say that succession starts the day you open your business, right?
Yeah,
So that you be thinking about your exit strategy from day one. Internal succession is always the easiest, right? Because you know each other, right? You're comfortable with each other. The clients usually know your internal candidate. So there's limited attrition or retention risk, transition risk from an internal buyout. Internal buyouts are also really convenient because if you grant equity to your up and coming, that equity can then be leveraged to gain the capital to then buy you out at a later date. So if you are planning really well, right, and you do have an internal succession plan, right, which is the most attractive, right, I would say in any type of, is just because of those risk variables. Um, so that means you've been mentoring and collectively working with this person for a period of time, and you just plan to pass the baton internally, right? That is the most beautiful way to cut a deal. But if you're an investment advisor or you're someone outside and you're wanting to invest in accounting firms and buy accounting firms, um, right, that transition becomes a little different, and you need to depend somewhat on those internal folks. And but the value, believe it or not, on an external sale is higher than it is on an internal sale.
right,
Um, is that because there's considered to be sweat equity in the internal sale, right? Where that person that's coming into play has earned their way into that through sweat equity, where the outside buyer should pay a higher premium because they haven't had that time frame. But so yeah, it's a lot of ways. Yeah, you should always be planning for succession. I think that one of the best ways to prepare, though, in the short term, meaning that if you're planning to exit in the short term, is just start reporting income, right? A lot of professionals are they're tax mitigation strategists, right? And they're applying the same tax mitigation strategy they serve their clients with to their own businesses. But then it's also disseminating the value of that business, because the value in these lies in the ability to gain capital to pay for them. The ability to gain capital lies in the ability of the cash flow of the business. And if there's not a historical net income revenue margin, then it's hard to gain capital. It's hard to gain buyers. So it's economics 101 kind of variable, right? You're holding up two tax returns. One has a lot of income, one has a loss, right? Which business is worth more? The one with the income, right?
right.
So reporting a loss annually, and then you try to sell. What are you selling? So stop mitigating and start strategizing. Pay a little bit in taxes so that then you can gain a little bit more in capital down the road. But then you'll have to pay a little bit more in taxes too on that. But
Yeah,
that's
but at
fine.
least you sold your business.
Right. That's right. That's right.
So I guess that speaks to the short term seller. If we're looking more long term, say, I'm 64, I'm looking to possibly retire in the next couple of years. How do I start assembling the appropriate team to sell my CPA practice?
Well, there's a lot of again, I think it depends.
Yeah, that's kind of a loaded question.
If you have a lot of time, right? So if you had 5 years to prepare, I would say I would be, trying to look internal, try to find your succession plan before having to go to the open market or go, there's a lot of ways to find buyers, whether that's through your local societies or your own social interaction with other accountants in your area, other investors or other business people, entrepreneurs in your area,
Or
right?
fiddling.
Yeah, or within yeah, exactly. Yeah, or within your team, or but if you have that kind of time, but then if you get short on time, then there's a wonderful array of intermediaries out there that'd be more than happy to represent you and can quickly find you a buyer, right? That's that's I'd say the benefit of working with a someone you're gonna have to pay commission to, a broker, is that they do have a very very long list of buyers. So strategy depends on your personal circumstances, right? And you and your goals. Your best money play nowadays to gain the most value is to long-term succession, right? So if you sell to a capital, if you're a seller, right, and you're willing to stick around for a decade, right, you have a lot stronger play from what you can get in that succession in that particular type of deal, right? What do I mean by that? Meaning that an investor might be willing to buy you, let you retain a portion of equity while you continue to grow the firm, but also give you the capital to grow the firm, right? So that at a later date, you can capitalize on that larger equity portion. What you're seeing in private equity is the conglomeration of these, right? So if you get 10 sellers all on this same mission, right, they suddenly build a $20 million business that's now worth 10 times more than what it was as a single individually owned business. Um, it's a really game changer. But so if you have time, sell early and then
Yeah,
gain and then get in the equity game.
yeah, no, that's great advice.
But or
Now,
sell to an investment advisor that has a large book and wants to help you grow in that same way, right? I think that's strategically it's all going that direction, right?
yeah,
It's
that Amazoning of or commoditization of the family office model, I guess you could call it.
Well, it's a consolidation, right? It's
Yeah,
a force,
right.
force a market force consolidation, right?
Yeah.
Technology outsourcing, lack of talent is going to force this solution.
Well, you touched on technology there, and I know you and I and Daniel Lumsford, your trusty right hand man,
Yeah,
went to the AICPA conference a year or two ago.
yeah,
I remember seeing just, compared to the investment advisory world, which I thought was rich with technological innovation, I saw even more so in the CPA space. Can
yeah,
you just kind of, touch on some of the trends in the accounting firm space as it relates to technology?
yeah. So there is a little bit of an AI intermingling, right? They do have what I call semi-automated bookkeeping, right? So there's the technology is advanced enough that it can categorize and can read and those types of things. But the unfortunate part is it can't filter the data entry well enough to really truly categorize. So it still has to be reviewed by a human to make sure that it did it right. Right. So but I'd say in the next couple of years, we're going to see a massive shift of that data entry need or that data entry requirement. A lot more of the human review scenario, right?
Right.
But you're even seeing that now with, I'd say, offshoring is kind of the in between of um, U.S. talent and AI, artificial intelligence, right? So you've got the offshoring is the solution that the AI can't quite solve for, right? So what you're seeing now is more offshoring, right? Where it's you take the financial information redacted, right? You ship it out to India or the Philippines or even now it's South America, Central America, Mexico, all large accounting offices, all big data entry centers, right? People just inputting data. And then you get the data back completed, and then you review it and then stamp the names on it. You take the unredact it, right? And then deliver the finished product to the customer. That is the consolidation that has to occur because there's just not enough. There's not enough low-level workers in the U.S. to fulfill that need, right? Until
Right.
AI can completely solve for it, which I think, I don't think that's super far off, but it's still far enough away that the need in between tends to be the offshoring. But
Right.
technology, man, it's always moving. It's moving so fast, and it's fun to watch. It's changed a lot in just the decade I've been in the industry, and I can't imagine what it's going to look like 10 years from now.
Yeah, no kidding. It's almost scary to think about.
Yeah.
So, outside of technology, what are some of the major changes you've seen in accounting firms over the, past decade, 2 decades that you've been in the industry?
Yeah, it really is the private equity coming into the industry, right? The roll up, the mass consolidation, the the it's when I first started lending into the industry and providing capital to buyers and sellers, there's a lot of argument over how much cash belonged on the closing table, right? And so how much equity transfer value occurred the day of closing. I had I fighting against the AICPA, not to speak negatively, but just in the last 5 years, have they said that there's a cash component equity value to a firm? And why is that? That's because private equity is now here providing that,
Right.
saying all deals require cash at closing. But I was way before private equity. We're beating the drum over here as a bank, saying, hey, we've got a guaranteed lending program that allows us to, loan up to the valuation historical cash flow amount that can be supported by the historical cash flow. And so I'd say that the big shift of how is these things are transacting much differently than they were 10 years ago. Their values are much higher than they were 10 years ago, and their cash expectation of closing is much higher than it was 10 years ago.
Right.
So you would have been smarter. You've been really smart to buy accounting firms, 10
Yeah.
years ago, right? They're more expensive today than they were a decade ago. And I mean, transactionally, cost wise, they're more expensive. So
Well, I guess, not to take too much of your time. I know you guys are busy over there at United Midwest, but I guess in closing, if you could just lay out, some of the best nuggets you have for planning your succession or, your structure at least. Again, we start early, start when you begin your business, but what would you just leave as some parting comments?
Well, so I mean, there's a lot of thank God for the internet, right? Thank God for thought leaders, thank God for podcasts and the ability to have these conversations. I would say just educate yourself. That's the one disservice I think is that don't go to market without knowing what the market is. And because it is an ever changing, ever shifting market, but there's a lot of great knowledge and thought leadership and lean into that. Whether that's through these podcasts. Shout out to Sarah Sharp. She's a lawyer in Denver that only reps accounting firms. She puts out a lot of great thought content. um, there's just a lot of great education out there on how to don't go blindly into a deal, right?
Right.
There's too much knowledge out there being shared and you should be able to understand the playing field. And so, it's surprising to me how regional still some things happen, right? Meaning that's that you look at the U.S., like things act differently than in New York than they do in Georgia, right? But they act differently in South Florida than they do in Northern California. There's a lot of you know, misnomer just based on societal, you know, so all the CPAs think a certain way in a certain area, but it's not really how everybody else is thinking of it in the other 49 states. And so, don't be siloed, by your small social circle. Go out into the world and get the education that is out there and understand what your firm is worth, how much you can get for it, what prepare, have a structure in mind before even going to market. Understand what you want and desire and deserve.
That's great. Yeah, there's a huge amount of great stuff out there, and I really think, as we rebranded from Succession Link to FinLink, we've noticed that there is a need for education. And just for our listeners out there, we are bringing an educational component to FinLink, and hopefully, Shannon, you can be one of the players to add to some of that discussion. So and
Yeah, happy
content.
to.
Yeah. Well, if
Happy.
someone wants to reach out to you, I mean, we will have a landing page on FinLink that they can get in
Yep.
direct contact with you.
Yep. Yep.
Um, so,
Well,
expect
listen,
people reaching out after this, I'm guessing.
thanks. Well, listen, I'm a crazy guy that always does this on every podcast. I've been accused of being a fool for doing it, and it's probably why I get spammed all the time. But my phone number is 614-648-9199. Call me if you need anything. If you don't get me, leave a voicemail. I'll always call back. Email me at Shay, SHAY, at umwsb.com, umwsb.com. And then you can find me on LinkedIn and then on Twitter at SBA Shay.
And you'll also be on the FinLink social site as well. So
Yes, sir. Yes, sir. Can't wait to hang out there.
Yeah, definitely. Well, we look forward to having you. And thanks so much for joining today. I really appreciate it, Shannon. And we'll definitely be talking soon.
Thanks, Sandra. Talk to you soon.
All right. Take care.